Hello, welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we unpack the key developments shaping credit, explore the macroeconomic forces at play, and dive into the strategies that matter most for investors across Europe and the UK. This week, first of all, happy Thanksgiving to our Canadian listeners, and of course, a nod to the kickoff of the NHL season. We'll bring you highlights from the Society of Professional Economists annual event, share insights from last week's Eurogroup and ECOFIN meetings, and offer a read on the recent market volatility. All right, let's get started. On Monday, I attended the Society of Professional Economists annual event. Always a thoughtful forum for forward-looking discussions on the global economy, and I left with three main takeaways. First, geopolitics is back at center stage. That's not a surprise to anyone, but despite the signing of a recent peace deal in the Middle East, a panel of geopolitical experts warned that global tensions could still rise in the coming years. Their consensus: the world is fragmenting into competing trade blocs, one led by China, the other by the US. Europe, they noted, has a unique opportunity to lead a third, more independent grouping, but so far it has been slow to assert itself. Second, the rate outlook remains anchored in higher for longer. Across multiple panels, the view is consistent. Interest rates are unlikely to fall meaningfully anytime soon. Risks of inflation reacceleration remain elevated, particularly in the UK, where persistent services inflation and sticky expectations continue to pressure the Bank of England. More broadly, the idea that the theoretical neutral rate may be higher than previously assumed suggests that central banks, especially outside the US, may not have much room to ease. Now let's put that in context with the latest data. In the euro area, headline inflation rose to 2.2% year on year in September, up from 2% in August, per the ECB Eurostat data. Core inflation, which excludes food and energy, remains slightly higher at 2.3%, driven by services and non-energy goods. While energy prices declined about minus 0.4%, categories like food, alcohol, and tobacco rose roughly 3%. The inflation picture has shifted from energy-driven shocks to more structural demand-side pressures, particularly in services. In the UK, inflation remains notably stickier. As of August, the CPI was 3.8% year on year, with the broader CPIH, which includes housing costs, at 4.1%. A speaker at the event noted that the Bank of England remains particularly focused on embedded core pressures, and that bringing inflation back to target will require sustained monetary discipline. In Sweden, headline CPI dropped to 0.9% in September, but the Riksbank's preferred CPIF measure, which excludes mortgage rate effects, held at 3.1%, showing that underlying inflation remains quite resilient. In Norway, CPI inflation came in at 3.6%, while underlying inflation stood at 3%, suggesting that domestic demand and wage pressures continue to play a role. Third, the sovereign debt pressures remain front of mind. In a panel featuring KBRA's own Ken Egan, participants discussed the elevated debt levels faced by governments globally. While few expect meaningful change soon, the consensus was that these burdens are becoming increasingly difficult to manage. Sovereign debt is rising faster than growth, and as a result, markets are changing faster than policy. Credibility is the new currency in the government bond markets. Debt issuance could become more strategy-based, shifting to supras, different state tools, and an evolving list of investors. Governments currently have more focus on the shorter end of the curve, which clashes with monetary policy, and government budgets, which all leads into debt sustainability challenges. The key challenge. Shifting to Brussels, last week, finance ministers from across the euro area gathered to prepare for the upcoming IMF and World Bank annual meetings. Pascal Donoghue, president of the Eurogroup, emphasized that while macro uncertainty remains, the Eurozone continues to demonstrate resilience. He reiterated that national and regional capital markets initiatives are welcome, but they must be reinforced by top-down EU action. The meetings focused on structural priorities, not short-term interventions. And among the key themes were advancing the Savings and Investment Union, deepening capital markets integration, enhancing fiscal flexibility and regulatory efficiency. Importantly, Germany and France appear to be softening their resistance to ceding greater authority to the European Securities and Markets Authority, or ESMA, a move that could significantly accelerate capital markets reform. Stablecoins also featured in the discussion, framed as a forward-looking issue. The consensus, digital assets will play a growing role in financial infrastructure, but the regulatory framework must evolve in lockstep. Turning to the markets. October has brought some renewed volatility across capital markets. Rising trade tensions and broader macro unease have prompted a degree of investor caution. We don't see this as a breakdown, more of a healthy correction at this point. Spreads have backed up, but not alarmingly. The iTraxx crossover spreads have widened about 280 basis points, up from tights inside of 250, but still well within their 5- and 10-year averages. European credit continues to be shaped by a steady macro data, a busy primary calendar, solid fundamentals with low defaults, and a patient ECB, as signaled in the minutes in the October 9th meeting, which struck a wait-and-see tone, supportive of carry and conducive to new issuance. In September, euro area flash inflation ticked up to 2.2%, as we highlighted earlier, bolstering the narrative that the ECB will remain on hold for now. A notable headline came out this week for any financial investors. A Swiss court ruled the 2023 Credit Suisse AT1 wipeout is unlawful. While the scope of potential redress remains unclear, the ruling has reintroduced some volatility into bank capital markets, particularly among those AT1 holders. Our take on the market volatility? Well, if you look to the equity markets, equity market valuations remain within reasonable bounds. European equities have performed well this year, but much of that has been a catch-up in the earnings multiples picture. For credit investors, investor skepticism around Europe's growth path persists, but with structural reforms on the table, we still see potential upside. And finally, a forward look. Third quarter earnings season is underway. Major investment banks are optimistic, citing strong deal flow in the prior quarter, and we'll be watching closely for corporate guidance that could shape expectations into 2026. That's it for this edition of the Credit Compass. If you found today's episode valuable, follow, rate, and share the podcast. And if there's a topic you'd like us to explore, drop us a line. We'd love to hear from you. For deeper credit insights and ratings, visit KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.